for our monthly webinar, How Plan Sponsors and Participants Are Reacting to the Coronavirus Market Volatility. My name's Steve Puckett, Vice President of Retirement Plans for Gateway Retirement Consulting. Again, thank you very much for attending. As a quick housekeeping note, we will be muting all lines during the presentation, and then we will be taking questions either via the chat or after the presentation. Again, thank you very much for attending. Again, just a reminder, Gateway Retirement Consulting is an independent full-service consulting consultant. We provide many various topics and services for our corporate clients, including fiduciary support, which includes comprehensive and ongoing fiduciary guidance, committee training, support to mitigate any potential liabilities, fee benchmarking, target date fund analysis, full investment analysis as a full fiduciary to the plan, courageous plan design, and employee engagement. Again, we're finding with the market volatility, employee engagement is very important, and many of our clients are looking to offer webinars, one-on-one support, and Q&As and FAQs for all of their employees. So again, Gateway Retirement, we're a full-service independent consultant. Just want to share with you some of our monthly webinar series in the future. We are having a lunch and learn on June 3rd. We'll be covering HSAs, the CARES Act, and target date funds. Later in June, we will have a cybersecurity presentation for plan sponsors, what plan sponsors need to know about cybersecurity and protecting the organization and the plan. We'll also be covering long-term care, understanding and planning for that for your employees. Some of our webinars of the past are available on our YouTube channel. If you go to YouTube, you can just type in Gateway Retirement Consulting, and you'll see a full suite of all of our webinars that we've done. Women and Wealth, how women need to look at other different ways of saving. We also covered transforming Social Security into a winning strategy. We've also have coronavirus and a recent market volatility. And then again, fiduciary failures, to name some of the webinars that we have available on the website. Again, quickly for the agenda today, we'll introduce Gateway Retirement Consulting, what we are seeing with regard to the CARES Act provisions. Then we will turn it over to Prudential. Russell Newton and Brian Wilhite will talk about what Prudential is seeing with regards to the CARES Act from a plan sponsor and a plan participant standpoint. We will then turn it over to Jeff Moscow from T. Rowe Price. T. Rowe Price has put together a fantastic survey on what they are seeing with regard to plan sponsor and participant activity. And then we will close with Q&A for the rest of the presentation. Very quickly, just want to go through, again, the CARES Act and what the CARES Act is. Again, remember there are 4 major bullet points to the CARES Act. And again, that's what we want to frame this discussion around. First and foremost, the CARES Act allows for coronavirus-related distributions from the retirement plan. These are called CRDs. Again, the industry loves nomenclature and abbreviations. So the CRD, coronavirus-related distributions, can be up to $100,000 and must be distributed before the end of the year. Participant must be eligible, so they obviously have to have a corona-related financial hardship. The 20% federal withholding is not required, and the taxes can be paid over a 3-year period. Again, all of these provisions are voluntary to the plan sponsor, depending on the service provider. So most importantly, depending upon who is your 401k provider, you may have to elect one of these 4 options for all of your participants, or they may automatically opt you in to one of these 4 options as well. So remember, each service provider, whether it's T. Rowe Price, whether it's Empower, whether it's Fidelity, all of them have their own way of implementing these 4 major provision changes. So you need to find out how your service provider is handling these provisions. Some may automatically sign you up for them. Others might sign you up for 2 of them. Others, you may have to elect any of the 4 options. So again, find out what your service provider is treating them. Again, each service provider is treating them differently. Again, the second provision is increasing the loan provision for a maximum loan from $50,000 or 50% of your vested balance up to $100,000 or 100% of your vested balance. The third provision is delaying of loan payments. So loan repayment, again, this could be optional. If your plan does not allow for loans, option number 2 and option number 3, you would have to amend the plan documents before you could incorporate the CARES Act changes for loan increase maximum and for the loan repayments. Again, so make sure, again, you know what your service provider is doing. The last of the 4 major changes is the suspension of required minimum distributions for 2020. Again, most of the people that are taking required minimum distributions want to take that money, need to take that money, so we don't see this as a big option. The first 3, the corona-related distributions, the loan maximum up to $100,000, and then the loan deferments are the big ones that we are seeing. Obviously, pensions and DOL, there are some other aspects, but the big 4 are what we're looking at. Okay, and again, most importantly, each provider has their own way of doing it. So again, make sure you know how your service provider is treating these 4 provisions. And then again, that will lead in terms of what we're seeing in terms of each service provider and the numbers that they're seeing. So without further ado, I'd like to turn the call over to Brian and Russell.
All right, perfect for that. Thanks, Steve. My name is Russ Newton. I'm a new business consultant here at Prudential, and what we're here to do, as Steve had mentioned, is share a little bit about what we're seeing within our book of business. So in the next few moments, I'm going to talk a little bit about what we're seeing from a plan sponsor level, but more importantly, jumping into giving you a sense of what we're seeing from a participant lens. That's truly telling, and certainly some interesting data and information that we've seen on our end. So as you'll see on your screen right now, we have some figures. This is as of April 27th, and we can provide some additional insight behind this, but as of April 27th, we had returned and had a response of 31% of our book of business, providing us with direction as to how and what various aspects of the CARES Act they wanted to adopt. The greatest adoption rate was within our loan suspension, so allowing participants to suspend loans for up to a year, at 83%. We had seen 74% of the 31% population that had responded around the various CARES Act provisions look to adopt various iterations of the corona-related distributions provisions, and I'll speak a little bit more to that in a moment. And then third, 60% of the 31% have elected to increase that loan limit to $100,000. Now, when we start breaking this down into markets, this is where we start to see some of the interesting pieces. As far as just a general response rate, the highest response rates that we have been seeing and have been seeing up to date has been from our corporate and Taft-Hartley groups. While on the other hand, we've only actually heard back from 21% of our book of business within specifically the healthcare markets and 28% within our governmental clients. Now, with that said, as I mentioned, I did want to dive a little bit deeper into the corona-related distributions, giving us more of a sense of what are each of these markets taking out. And within the corporate space, we've seen a majority of our plan sponsors allow for that provision for the up to $100,000, similar in our healthcare markets and our governmental markets. The only outlier that we've seen up to this point is within our Taft-Hartley market, in that 48% of our respondents have allowed up to that $100,000 limit. More often than not, we're seeing them provide lesser amounts of withdrawals, whether it be $50,000 or that $25,000 mark. Now, with that said, I did want to touch on a few pieces from more of a participant lens, and starting with just enrollments. So within Prudential's book of business, and the COVID-19 volatility, we really haven't seen a material impact on the overall number of new enrollments yet. Year to date, in fact, we continue to remain 5% ahead of where we were last year. Although when we do look from February 24th, which is what we would consider the beginning of the coronavirus and the epidemic, we have actually seen a drop. So we were down 11%. Now with that, we take a look week to week. So we're trying to dive into this data and really understand week to week where we are. And the story is changing, but compared to last week's enrollments that we've seen, we are significantly down, but we attribute that more so around the auto enrollments that we had during our first week of May, which had a slight uptick. Now, one of the interesting pieces of data from a participant lens that we've seen is specific around savings rates. So naturally, year to date, we have seen an increase in individuals coming and making changes to their contributions rates, 25%, and that's looking at it very broadly. So whether we're increasing or decreasing, we've seen an uptick on that. Certainly, we have seen a decrease among certain populations in contributions. So year to date, we've seen an uptick of 79% compared to last year of individuals actually coming into the account, calling into our call centers, and lowering their contribution rates. The largest drop, in fact, has actually been within our demographics, individuals within the ages of 55 to 64. Now, the flip side to that coin is, what have we seen from a contribution increase standpoint? And this is some of the exciting information that we have, and I'm sure Jeff will be able to speak to this from T. Rowe's perspective as well. But year to date, we're trending 12% as an uptick in activity of individuals actually being proactive and increasing contributions. Now, it's not our older generations, the 55 to 64, but this data is truly being driven by our under 25 population and individuals between the ages of 35 and 44. So we find that extremely interesting. We're finding that participants aren't rushing to make changes, or they're not really being influenced as much around emotions. In fact, really looking to take advantage of where the markets have been in the past few months to double down and make sure that they're saving on their way to their financial future. So with that, I'm going to hand it off to my partner and colleague, Brian Wilhite. He's going to talk a little bit more about some of the participant level data that we're seeing in our books.
Yeah, thanks for that, Russ. I appreciate it. And thanks, Steve and Rita, for having us be a part of this webinar. We really appreciate it. So again, my name is Brian Wilhite. I am the Vice President, Regional Sales Director here covering New York City and New Jersey. So I wanted to share a little bit about investment changes, right? We've all seen, the market volatility out there. While it certainly, died down a little bit recently, the March volatility initially drove a flight to stability. As equities were sold and transferred into stable value and fixed income, there's a tremendous amount of money that was flowing into stable value during that March timeframe. And that was specifically related to participants aged 55 to 64. They account for a majority of those exchanges. And the good news is we have begun to see a tapering off of, moving money into stable value, and it's actually kind of flipped in reverse of moving money back into equities. And it's very much so slowed significantly since the week of April 20th. And it's really starting to resemble a state of pre-crisis normalcy. And during the week of May 1st, trading remains normal, which is something that we are happy to see. And as Russ was alluding to from a savings perspective and seeing a lot of people increasing their rate, I know Steve and Rita have done a great job with their clients of talking about, dollar cost averaging and the importance of focusing on the long term. So we're excited to see that type of information actually resonating through the stats we are seeing. From a withdrawal perspective, since the passage of the CARES Act, we've seen about 300 million approximately of distributions through early May. And overall, we've actually not seen the typical size of withdrawals that you may expect, given that you do have the ability to take up to $100,000. And actually 90% of the withdrawals we are seeing are lower than $30,000. The average distribution is actually right around $20,000. And individuals between the ages of 45 and 64 are taking the largest withdrawals. So again, that's another positive statistic. At the end of the day, Steve alluded to really paying attention to what your service provider was offering you in terms of an opt-out or an opt-in approach. Prudential did take the stance of doing an opt-in, allowing our plan sponsors as well as advisors such as Steve and Rita really have a productive conversation to make sure, each provision and really vet those through to make sure it makes sense for that specific organization, and that these retirement plans are really seen as a last resort for participants, because at the end of the day, a lot of people spend a lot of time contributing to these, and we want to make sure they're very thoughtful before taking money out. So this type of statistic that we're seeing related to the withdrawals was very nice to see, with it only being around $19,000, $20,000. The last thing I would allude to is just participant education, right? Participant education is extremely important. Allowing participants to be able to reach out to advisors and their service providers to really get information related to the CARES Act. One of the things that Prudential did do that I think is worth mentioning is, for any of our clients, is really just offering virtual coaching and one-on-one sessions with our retirement counselors that were free of cost. And to date, we've seen over 900 sessions already been scheduled with plan participants, and using services that include screen sharing technology and really live video feeds to really have that impact of, a lot of us are obviously quarantined and staying at home, but allowing participants to have that, one-on-one consultation with retirement counselors. And I know Jeff has a lot of great information from T-Row that he'll be able to share related to participant education and the importance regarding that, given the current environment that we are all in. So Steve, at this point, that's the high-level statistics that we're able to share. I'll pass it back to you.
Well, thank you very much. Again, we appreciate the insight from Prudential, from the Prudential team. Obviously, I think those numbers, very impactful. We always have this seesaw, the tough push and pull effect of do you have the leakage? Does it make sense for people to take money out of their retirement plan? Again, it's a tough give and take, and certainly, obviously, we agree with you that again, unless absolutely needed, the retirement plan probably is not a great vehicle to take distributions from. Well, with that, I will turn it over to Jeff Moscow from T. Rowe Price, and Jeff, you can start.
Perfect. Thank you, Steve, and glad to be on today. I will say from an overall perspective that we would like to focus on really two items within this presentation. Number one is plan sponsor trends and the adoption related to the CARES Act. And then number two, participant level trends and activity. So the Gateway team has done a tremendous job in terms of delivering content. What I'd like to do over the next 10 to 15 minutes is walk you through what T. Rowe Price is seeing. We have surveyed our book of business that equates to around 2 million plan participants. And what we've defined is really 11 weeks into the market event. So what we've done is we've taken from February 24th through May 8th. And with that being said, what we have identified is plan sponsors are slowly continuing to adopt CARES Act provisions. And participants, fortunately, similar to Brian's statements, they fortunately have, for the most part, stayed the course from an investment standpoint. So what we've identified is the fact that 55% of plans that are greater than 25 million have adopted at least one CARES Act provision. 99% of plans have retained their target date investments, and 96 participants have not changed their investments at all. What we've also seen is, and we'll go into this a little bit, is 14% of plans that have assets less than 25 million have adopted at least one CARES Act provision. So moving towards the plan sponsor CARES Act events, and just bear with me 1 second. What we've identified are those plans that have greater than 25 million in plan assets, as I have just mentioned, have adopted 55% of the CARES Act provisions, whereas 45% have not taken action in adopting those provisions. What T. Rowe Price has delivered is what we refer to as an opt-in service, meaning plan sponsors have the ability to select either all the provisions or to pick and choose. So what we've identified as well is the majority of these plans, or 23%, have adopted all provisions with the plans that are greater than 25 million. What we've also found are those plans that are less than 25 million in plan assets. The majority have not yet selected CARES Act provisions. So 86% of those plans that are below 25 million have not adopted the CARES Act provisions. A big component to that, I believe, is the fact that they may not have teams that are as skilled as Gateway to work with the plan sponsors to adopt these CARES Act provisions. As we look by plan size, the adoption by plan size, we have found that over 90% of plans have utilized corona-related distributions for those plans who are above $1 billion in plan assets. As an example, those plans that are below 50 million in plan assets, there's been only a 15% adoption with corona-related distributions. That is similar and consistent as it relates to plan size by participants. So we have found again that the larger the plans, whether it be from an asset size standpoint or participant population, have historically been more engaged with the adoption of the CARES Act. By industry, what we found is the leisure and hospitality, as well as the utility industries, have higher than average adoption rates. And as we look into, I'm sorry, one second, thank you. As we look into other industry trends, this is consistent. The adoption rates are consistent with the participant-based activity. And we provided all of this information in detail to Gateway, so you would have the ability to follow up with Gateway and to dig down into these numbers further. As it relates to participant level trends, what we found is that, number one, the overall participant population within our book of business as it relates to corona-related distributions, plans have made these available to 73% of overall participants. We've seen a participant usage basis of 1.3%. What we found as well is as of April 24th, we were at a 68% availability. With that being said, similar to my prior comment, we've seen the biggest impact both on availability and usage within the retail trade industry, as well as the leisure and hospitality industry. So we'll see that leisure and hospitality has 91% available and a usage of 2.1%. As we look by dollar amount, similar to Ryan's comments with Prudential, we're noticing that the average CRD or corona-related distribution dollar amount is $21,000. And the average distribution as a percent of average account size, meaning what my account balance is approximately 27%. Again, leading the way is the leisure and hospitality marketplace, as well as the retail trade. So unlike Prudential, all of our survey results are based upon corporate clients. We are not taking into account non-for-profit and government. What we've seen from a trend perspective on a week-over-week basis is that we have seen the pre-market average of distributions in percentages increase once the CRDs, the corona-related distributions, had been made available. So what we can see from this perspective is the week of the 13th of April, which was the first week that T. Rowe Price made available corona-related distributions, we had approximately 83% of our total distributions at T. Rowe Price be non-corona related. Going to the week of May 4th, we've then seen almost a split between corona-related distributions and non-corona-related distributions. So you can see the impact taken as a result of the overall percentage on distributions. What this slide ties into is really the market volatility going back to February 7th and the investment exchanges. So this is distribution aside. This is really what a participant doing from an investment allocation standpoint and an exchange standpoint. So you'll see that as the market declined, as we saw a dip around the week of March 20th, what we've seen is a spike in overall participant exchanges. Bear with me 1 second here. Steve, would you mind helping me?
Again, on this chart, very important. You know, the exchanges you can see spiked up early March, dropped down as the market stabilized, but then as the market continued to drop, you know, the number of transactions increased until the CARES Act was passed, and you can see the exchange activity actually shrunk and is back to a normal level.
Great, thank you. What T. Rowe Price has also seen is participant investment exchange activity, whereupon over 96% of plan participants have not made an investment exchange, and 60% of plan participants who made an exchange only did it one time. So similar to Brian's comments, participants are staying the course for the most part, and T. Rowe Price as a firm we're very happy about that as well. From a target date perspective, which is a large component of the book of business that T. Rowe Price has offered to participants, we have found that only 3.7% of participants have made an exchange during this current market environment. In general, those participants who have target date investments exchange less than other participants. So what you can see from the slide is if I have 100% of my account invested in a target date investment, only 1.5% of those participants made an exchange. However, if I have 0% of my money in a target date and I have picked and chosen my own funds to invest, we found that 8.7% of those participants who have made a change. What T. Rowe has found as well is from a call center experience, and I would assume this trend to be consistent across the industry, we've seen a relative spike in call volumes, and also it's correlated to the market, right? So if we look back to the weeks that we referred to with the market volatility, that's where we've seen the most activity. We're proud to say that T. Rowe has been able to accomplish 85% of our calls on the first call resolution. But what we've also found as well is the average calling time has increased by 21% or 2 minutes because plan participants are requesting and receiving more complex guidance. From a website experience as well, again, on a week-over-week basis, we've seen the most activity through the market volatility, but what we found is 74% increase in participants reporting interest, specifically in researching loans. And we have found that 3.5 times more visits to educational content compared with last year. As it relates to participant education usage, again, as you can see with the market volatility, we've seen that number increase and then it seems to be settling down. So T. Rowe Price has created a coronavirus hub for plan participants. The usage had sparked substantially increased the week of the 29th of March, but overall visits have more than doubled since the beginning of the market event. Non-Corona or non-CARES Act content has remained relatively consistent. Where we've seen the spike has been coronavirus and CARES Act content. Overall, on the participant tool utilization, one of the tools that we do provide to participants within our website and app is a distribution decision tool. And what we have found is that tool which helps them understand the potential long-term impact of making plan distributions today. We have found an increased use of that tool by 300% over last year. So that's just one example of one of the tools we have available for plan participants that has seen a substantial uptick. As it relates to that coronavirus hub that I explained earlier, in that content engagement, what we found is participants are spending 13 minutes on the site today versus 6 minutes who did not view the specific hub to the coronavirus. We've also identified that content viewers looked at 10 pages per visit, as opposed to only 5 pages per visit for those who did not view the content. And the coronavirus content viewers completed fewer transactions versus those who didn't view the content. So what we're hoping is that the education and the tools and the calculators that we push out to plan participants, what we've seen happen is really make an impact as a lower withdrawal rate.
And
so with that being said,
go ahead.
No, I'd like to turn it back to you, Steve. Thank you very much.
Oh, Jeff Moscow, thank you very much. Again, the information that T. Rowe Price has been able to glean in their book of business, I think is excellent. And again, I think just as a recap, before we turn it over to questions, I think the most important aspects of the situation, the market volatility, the corona-related issues that we're having is, as a plan sponsor, you need to know about these 4 options. You need to know, how your service provider is implementing them. A service provider might be opting out of 2 of them, but you need to opt in on the other 2. Again, you also, might be a business that is very heavily hit in the corona-related distribution world. So again, from a plan sponsor standpoint, reach out to your consultant, reach out to your service provider, and understand there are implications of offering the CRDs. There is implications about the loan deferment. Again, you need to understand how, if you defer the loan, how your service provider is going to re-amortize that loan starting January 1st of 2021. You do need to understand the complexity of the corona-related distribution, understanding how the 3-year taxes work, and understanding how your participant is going to adjust those 3 years worth of taxes. So again, make sure you understand the provisions. Obviously, make sure that you understand the impact of each of those provisions. And then again, from your participant standpoint, make sure your participants understand them. I want to just follow up with, on a participant standpoint, what we are seeing. More people are going online. More people are calling in. More people are using the mobile app. That is across the board, we're seeing it. Now, the question I say, is that because everyone's working from home and now they have no one looking over at their shoulder on their computer, and now they can go onto the Fidelity website at their leisure, and instead of spending 2 minutes just checking their balance, they can spend 10 minutes because their boss isn't looking at their computer? Yes, I'm sure that's it. But it is also more people want to be empowered on financial planning, on corona-related issues, and financial planning and distribution planning. So we are seeing call volume up, web usage up. Again, transactions are still relatively low, just what Jeff and Brian and Russell mentioned. But also that leads to kind of the next step is participants have become trained in volatility. Again, if you've been in the market, everyone remembers the dot-com crash of 2001 and 2002. Again, the market rallied all the way up to 2007, and then everyone remembers the financial Great Recession, Bear Stearns, Lehman Brothers, and the market has rallied since. So again, we always have to stress is if you're in the accumulation stage, under the age of 50, this is a great thing for you. You're accumulating your money. You want your money to accumulate more shares of mutual funds. Now, again, if you are in the deaccumulation stage, you need to understand that as well. And that's where you need to figure out how much money, what percent of your asset allocation should be in the stock market and should be at risk. But again, fantastic. Prudential, thank you very much, T. Rowe Price. With that, I will